Hello, I'm Clay Lowry from the Institute of International Finance. I'm the Executive Vice President here. Today, we're very glad to be partnering up with the IMF. The IMF has been working on the Global Financial Stability Reports chapters. And today, they're going to be presenting on one of their analytical chapters called Financial Sector Policies to Unlock Private Climate Finance in Emerging Markets and Developing Economies. This is as probably everybody knows who listens to a webinar like this, is that the IMF does the GFSR every 6 months with the spring meetings and the fall meetings. Next week will be the fall meetings that'll be taking place in Marrakesh, Morocco. Before we get started, just a couple logistical notes. This event is on the record, so it is open to press. But if you have questions during the event, please use the Q&A prompt at the bottom of the screen to submit your questions. We'll try very hard to get to them. My colleague, Sonia Gibbs, will be moderating a session, and she'll make sure she works that in. With no further ado, I'm just going to give a few contextual points, and then I'm going to turn it over to the IMF team so that they can make their opening remarks and kind of explain what they've tried to do in their analytical paper. My contextual points are the following, which I think many people will know, which is reaching the Paris climate agreement goals is going to require a lot, and it's going to require it fast. There's a drastic 50% reduction in global carbon emissions by 2030 is going to be required. Investment needs, we've all heard about them, trillions and trillions of dollars. Best estimates, and they're clearly just estimates, are to achieve net zero by 2050, we'll need to invest $6.4 trillion. I love the 0.4 trillion per year in low emission assets globally. And a lot of this is going to have to take place in emerging markets. And of course, in emerging markets, there are a lot of challenges that are going to be daunting challenges to overcome this. Some of them are structural issues, such as a heavy reliance on fossil fuels, a poor regulatory climate at times, lack of bankable projects. Some of them are more cyclical, such as limited fiscal space, a prolonged weakness in getting into international capital markets, a heavy debt burden, a rising debt burden, I guess. And then, of course, then there's kind of these broader global issues, such as tighter global financial conditions and heightened geopolitical tension. So all of those are constraints and that will be tough to overcome. I think that the IMF has tried to actually work through these issues and try to think about what will kind of work best. They're going to have to try to figure out how to help countries with a pro-growth strategy, with trying to keep out of debt distress so that capital flows will continue actually into these countries to actually continue to invest. So not just doing debt restructuring for the sake of doing debt restructuring, which some people actually argue for. Trying to figure out how can you use the multilateral development banks to actually catalyze even greater finance. So there's a number of aspects to this, and we're glad that the IMF has actually done some really good analytical work to try to figure out what could be done to help achieve some of these things. But instead of me talking about it, let's go to some of the experts that have been working on it. So I'd like to actually introduce two folks from the IMF who have been doing the bulk of the writing, the bulk of the analysis on this. Torsten Ehlers, who is the Senior Financial Sector Expert for Monetary and Capital Markets at the IMF. And Charlotte Gardes Landolfini, hopefully I pronounced that right, who is the financial sector expert for monetary and capital markets at the IMF. So, Torsten, over to you.
Thank you very much. So I'm waiting for the presentation. Okay, we have a couple of slides, just very quickly in the beginning. There we go. All right. So thank you for the great introduction. Thanks for tuning in. As was already mentioned, so the title of this chapter is Financial Sector Policies to Unlock Private Climate Finance and EMDs. So we basically packed the two main messages of the chapter into the title. So first message is we'll need a lot of private finance to tackle all the investment needs that are necessary to achieve climate goals. And then the second message is, and as was already mentioned in the introduction, that attracting private climate finance will not be easy in emerging markets. So there is a host of policies that will be needed to do that. So why do we think there's so much private finance needed? So first of all, investment needs are huge. So on the left-hand panel, you can see a couple of the estimates that are out there. And one of the most prominent estimates is that for emerging markets and developing economies, we'll need about $2 trillion a year by 2030. So currently we have about 400 billion of climate investments in emerging markets. So that will have to be ramped up fivefold in the next 7 years. That's a pretty steep task. And, based on the IMF projections for what public sector investment is going to be, and also, considering the somewhat tighter financial conditions, we made an estimate in the chapter that if you take this for granted, the projections for public investment, then in emerging markets, around 80% of the investment needs will have to be covered by the private sector, which is a lot. And not only this, is a lot more than it is currently, because currently it is about 40%. So we'll have to ramp that up by another 40 percentage points to 80%. It's even higher than that if you include China. So generally it's believed that China has plenty of domestic financial resources, and obviously the public sector is also playing a bigger role. So excluding China, that is even higher. So probably the private sector will have to cover 90% of all climate investments. So before we come to the second main message, which is that we'll need a host of policies to actually achieve that, we'll have to analyze, and this is what we do in the chapter, we have to analyze what the main issues are that we can actually tackle by new types of hopefully very efficient policies. So one issue that was already mentioned in the introduction is really the fact that there are low credit ratings across a lot of emerging markets and developing economies. So here in this graph, you see 4 panels for EMDEs with different levels of income. So furthest to the left are the countries with the highest income, and then as you move to the right, you get to the low-income countries. So what you can see is that only the green triangles basically symbolize countries that have an investment grade rating, and that, as you probably all well know, is often required by large institutional investors, sometimes even by regulation. As you move further to the right, to the low-income countries, you have all the yellow dots, and those basically signify below investment grade. So lots of countries below investment grade, and that will make it difficult to attract private capital, both domestically and internationally. But here's a second point also, which is more specific to climate finance rather than private finance more generally, which is the fact that you see here these 4 different panels, and they have lines which are in the beginning sloping upwards, which means that the higher the E score, or the better the environmental policies, the better is the credit score or the credit rating, sorry. But that is only true for the economies that are on the higher income side. So once you move towards the low income countries, there's actually a negative relationship, meaning that even if these countries actually implement strong climate policies, they do not benefit from this in terms of their sovereign credit rating. Another issue, big issue that was also mentioned, is the still pretty strong investment in fossil fuels. So here you see the historical data, and it's both true for coal, which is on the left, and then is also true for oil and gas. Now, the oil and gas industry obviously also does clean energy investments, But as you can see in the right-hand panel, those are really, really small compared to the other capital expenditures they have. So that's also lacking. And that is also true for new capacity. So on the left-hand panel, you see what is planned in terms of new capacity, and that is quite a lot, in particular in emerging markets and developing economies. But that's not true for all countries. So obviously, there is a lot of country variation in all the things that we have been showing. And one way to show this more clearly is the right-hand panel. So there on the y-axis, you have a climate policy performance index. And it shows that basically the countries that have stronger climate policies, they also have fewer capital expenditures in fossil fuels. So that's good news. But I'm now handing it over to Charlotte to discuss the rest.
Thank you. Indeed, we have also looked at the banks and the insurers' climate policies, and we see that they lack robust alignment with net zero targets. So what we have done is looking at the climate policies that are published by the 30 GSIBs, and we see there that not only there are limited criteria when it comes to phasing out of coal, for instance, but also limited criteria when it comes to transition financing of the oil and gas industry. This is all the more concerning that large banks and insurers, they are potential investors in EMDs. And yet we also see, thanks to the research, that the more robust the climate policies of banks are, the greater impact it has on the decarbonization of the oil and gas industry. So this is what you can see on the left-hand side of this slide. What we have also looked at is the actual lending to fossil fuel companies. And there we see that GSIB lending to fossil fuel companies has remained stable throughout the years following the Paris Agreement, but also has increased in the aftermath of the pandemic. Something that we have wanted to analyze is the fact that the share of sustainable loans to these fossil fuel companies has actually not increased that much at all since the Paris Agreement, even for those banks that are assessed as having more ambitious climate policies. Something also that we think is important to look at is the role of investment funds. They have emerged as very important players when it comes to private financing of climate change mitigation. And we see that climate impact funds, however, are very small in the total share of investment funds. Climate impact funds, however, allocate a larger share of their portfolios to EMD assets, both for equity and for bond funds. So these are very much important to look at. It's all the more true that actually their share of allocation to EMDs is higher than overall investment funds. So something we have tried to do is actually looking at the construction of climate scores. So as all of you probably already know, the current design of corporate ESG scores does not appear to steer private finance towards climate change mitigation and climate impact, because corporate ESG scores, they are not designed to actually capture they are designed to capture non-financial risks and not to capture climate impact. And this is related to the construction features of these corporate ESG scores. So we have seen that new types of climate impact scores can actually be constructed using the same data points that ESG scoring providers already collect. And we see there that impact-oriented scores, particularly for climate impact, could be useful for asset managers and foster greater transparency for investors. So what you can see on the right-hand side of the slide here is that climate impact-oriented scores would yield actually a substantially different ranking of firms than the E scores. You see that the firms within the worst 5% under the impact score can actually have a higher rank under the E score. So for investors that would consider using those impact scores, this could significantly affect the allocation, the portfolio allocation, including to EMDs. So in a nutshell, to tell you about the policy recommendations of the chapter, something very much important to stress from the very beginning is that there is a mix of policies that can be implemented in emerging markets, developing economies. Carbon pricing, it can be highly effective in pricing climate externalities, but also in creating transition opportunities. However, given their distributional and social effects, it could be politically challenging to implement in EMDs. This is very much important to focus on carbon pricing, but also to focus on the reform of fossil fuel subsidies, which are at the record high in EMDs including. So something we elaborate upon in the chapter is primarily the strengthening of the climate information architecture, data, disclosures, alignment approaches, including transition taxonomies. Something we also look at is the role of just energy transition partnerships and the need to come up with financial instruments and innovative financial instruments to phase out coal. Also, something that is very much important and backed up by the analysis in the chapter is the goal of having climate impact-oriented financial sector policies. So those not only related to the climate information architecture, but also to disclosures and to labels for investment funds and sustainable investment funds. Transition plans for banks also could be a useful tool for macroprudential authorities in order to develop that forward-looking view of whether the risks that are resulting from a financial institution's transition strategy can actually be commensurate with their risk management framework. Something very much important is the role of credit rating agencies and sovereign ESG methodologies. They need to be realigned to meet growing investor demand and this for climate-related goals. Public-private risk sharing is also critical to foster climate-private investment in EMDEs. The expanded use of guarantees by multilateral development banks and financial structures that allow for pooling, for diversification, and for credit enhancement that can reduce the cost of private capital and attract that broad range of private investors. And finally, the RSF, the Resilience and Sustainability Facility that is supported by the convening power of the IMF, can act as a catalyst by bringing together the governments, the MDBs, and the private sector to foster the financing of climate change mitigation in emerging markets and developing economies. Thank you.
Thank you so much, Charlotte and Torsten. That was a really wonderful presentation. And, you know, we want to turn to a panel discussion now, but first I wanted to note that the impact, the climate impact of private sector financing, as you say, is very much in focus now ahead of the annual meetings in Marrakesh and ahead of COP28 in Dubai. And it's really good to recognize the role of all the different pieces of the ecosystem, as you set out in your rather excellent graphic there. Certainly transition plans are also capturing attention in the regulatory community. And it's just really important to note that it's a whole set of economy policies, economy-wide, and not just the financial regulatory community that's going to drive this transition. So let me turn now to our very distinguished panelists here, and I'll introduce Jay Collins, who's Vice Chairman, Banking, Capital Markets and Advisory for Citi, and Fabio Natalucci, who is Deputy Director, Monitoring Capital Markets Department for the IMF. Welcome to you both, gentlemen.
Great to be here.
And
thank you. Great to be here.
Wonderful. Jay, I want to start with you, and maybe just to take a step back a minute and for context, we've been talking a little bit about the private sector transition planning and finance. It was really interesting during Climate Week last week in New York to see Secretary Yellen unveil new net zero principles from the US Treasury. And I wondered, you know, all of these net zero commitments are going to play a role, aren't they, in mobilizing finance for the transition? What are your perspectives here?
Thank you, Sonia. So, you know, if you look at these 9 principles of the Treasury Department, they are all of them about operationalizing against the plan. I mean, ultimately, the first one is the plan itself, but you're fundamentally talking about metrics and alignment and transparency, manage, phase out. But what you're really saying is you can't commit without operationalizing, and that requires a sector by sector approach to transition pathways. And fundamentally, it requires, and this is so important to understand, is no bank, Citi, or anyone else can operationalize unless the clients are moving in that direction. And a bank with a commitment and that embeds the principles laid out by Secretary Yellen has to have clients that are on that pathway. They can be facilitated, coached, worked with on that plan financially by their financial institutions. But the at the end of the day, the transitioning clients need to be working with those financial institutions to transition. So I applaud the principles and their intent. Let me say one last word about that, though, quickly, is we are going to talk a little bit more in a second about this concept or this comment by the IMF, 90% of the transition needs to be done by the private sector, funded by the private sector, and the difficulties of assuming that the official sector can actually do this on its own. And we're nowhere near there. We're nowhere near there. And so one of the things that I think is so important to understand is that a lot of the funding of green is off balance sheet. It's project finance. And so when you really look project by project, you can have all of the commitment you want to transition as a financial institution, but given the regulatory environment that we have post Basel III and the financial crisis, that is unfriendly to banks, discourages banks from project finance and infrastructure lending. We have this juxtaposed position of banks needing to transition, of the world needing banks and financial institutions to transition. But at the same time, that transition will go from on-balance sheet brown to off-balance sheet green, more or less. And therefore, if banks are basically not part of the story of project financing and project lending due to regulatory constraints, and every time we look at a mitigation structure from the MDBs, they don't mitigate regulatory risk. And every time a bank looks at a transition project and is stuck with regulatory returns that underperform due to the regulatory framework, we have to acknowledge that problem. And so fully embrace the principles and the need to operationalize, but we have a lot more to do.
Thank you, Jay. And I want to come back to you on that question of potential regulatory barriers as well, because it's a really important one. And I also wanted to underscore what you said about the need for engagement with clients on transition. Maybe that should be an integral part of the ecosystem, going back to the presentation from Charlotte.
And may I just say, Sonia, RMI
Yes.
is doing some extraordinary sectoral work with us and others. And one of the things that went along with Secretary Yellen's principles are a whole series of other actors that are playing a role. But this sectoral approach, rather than a top-down government approach, really looking at sectoral commitments and their micro-level pathways, and then how they transition based on that. Look carefully at what RMI is doing, because it's critical, and that we keep rolling this out to other sectors is going to be very important.
Thank you so much. Yes, we'll be sure to continue to draw attention to that. But Fabio, Jay was talking about some of the constraints on private sector finance. So when you think about all the work that you did for this chapter, what in your mind constitutes some of the biggest barriers to deploying private climate finance?
I think I would bucket the barriers into like three groups in some sense, right? So one has to do with like emerging market specific issues. Charlotte and Thorsten show you before, for example, the correlation between the E and the credit ratings, right? So the ratings of emerging markets, a big chunk, more than 50% of this country don't have investment grade ratings. And so there are a number of constraints that unrelated to climate in some sense. They are just generally related to investing in emerging markets. Ratings is one of them, so that excludes some global investor from going to emerging markets if they're not investment grade. There are others that have to do with the macro backdrop, so the macro stability, the institutional and policy framework, FX risk. So there's a number of risks, a number of constraints of hurdles that are there that are related to investing in emerging market more broadly. So there is one is that bucket of barriers. There's a second bucket that I think I would call the prerequisite. So things that need to be in place to make the investment conducive to attracting private capital. Those include, for example, policy like carbon pricing that, again, that had been mentioned before, price signal that essentially are able to shift flows through the private capital toward renewables and greener investment. But obviously, carbon price is not the only tool. There's a need of policy, more broadly, climate policy in place, like specific goals that countries have in mind in terms of transition pathways. So having in place essentially a robust climate and framework, a climate policy and climate objective. Then what Charlotte and Thorsten have called the climate information architecture. You need to have quality data. They have to be high quality. They have to be consistent, comparable, so that the investors, the private sector, can actually price risk and opportunities in this sector. We need to have in place also disclosure, global disclosure. So the ISSB work on having some minimal global standard in terms of disclosure. That's very important to minimize the risk of fragmentation in this market. And then the issue of taxonomies, classification, alignment approaches, whatever you want to use it, call it. That's why the points pulled out that Secretary Yellen has been important. But there are more than 200 taxonomies, classification, alignment in the world. And so again, trying to move the needle toward a more harmonized approach to that. That's the climate information architecture. And then there is a third bucket. The third bucket has to do with specifically demand and supply for capital related to emerging markets and to climate. In terms of demand, it's the bankable project. In some cases, there's lack of projects to invest in. So how to increase the pool of bankable project that can actually be brought to market from the design, the deployment, the execution of this project to actually bring into market. Then there is supply side of capital. Number of hurdles that has been mentioned before. Jay mentioned to some of them. They have to do with the fact, for example, that some of the structures are very bespoke, are difficult to scale. The risk reward doesn't work for the private sector. So there's a need of risk sharing between the private sector and the public sector. The role that the public sector can play, but also avoiding moral hazard. In some cases, private sector can do the job without public capital. So I would bucket the barrier into these three groups, and maybe you can dig deeper into each of them.
No, absolutely. And it's a really great way to sort of identify some of the meta issues that are standing in the way. But Jay, I want to come back to you here because you had mentioned one specific set of issues around potential regulatory barriers. And, when you think about the type of thing that Fabio's been describing, de-risking, making it easier for the private sector to channel flows to emerging and developing economies, do we need change to the regulatory treatment of blended finance assets? Oh, I think you're on mute, Jay.
I'm so sorry. So Sonia, I have said that we need the regulators at the table because I think that prudential regulation is something that requires a deep thought in terms of assuring that we prevent the systemic risk challenges that we had during the financial crisis. And Basel III was crafted for critical reasons. So, but let's go to the for a second the need to have them at the table. So, if we look, for example, at the MDB reform that's happening now and all of the risk mitigation tools that could be used to crowd in the private sector, there is quite a bit of potential regulatory leeway in the interpretation. Let's take the final interpretation of Basel III by U.S. regulators. We know that to be true because if one actually jumps into the details of G7 regulatory treatment, they're differentiated, meaning that you have the same Basel III framework, but you have the Japanese, the French, the US, for example, interpreting a lot of that differently. And so it's important to have them at the room to look at those interpretations, to update them based on what we're seeing as a lot more data out there on how infrastructure has performed in the developing world and in the developed world against corporate exposure. And that also that as policymakers come to a conclusion that this transition is mission critical, to have dialogue between the climate policymaker and the financial regulators, with maybe NGFS at the center of that table, to really talk about a united front on messages to the financial system on what exactly it is supposed to do. Because one of the most frustrating things for executives in the financial community is a pension with a fiduciary responsibility, a insurance company with a Solvency II and Basel III interpretations of the banks, is to have, first of all, the desire to do good and do well, the desire to transition, to be net zero committed and operationalize that on one hand, but then have policy and regulatory constraints on the other that send a very different policy signal to you going forward in terms of that behavior. And oftentimes those messages require alignment in dialogue, not just with the private sector, but dialogue amongst and between the policy community, particularly within the G7.
No, absolutely. And we hear that quite a lot, you know, the need for the right hand to know what the left hand is doing, for them to work together and not in opposition. So Fabio, I want to come back to you here with a $64,000 question, or maybe 64 trillion, given the numbers that we need to speak about. How do we encourage greater private sector participation? And, you know, maybe talk about a little bit about blended finance. I know you're doing a lot of work with the Network for Greening the Financial System, the NGFS, on that topic. So talk us through it.
Yeah, so blended finance, I think it's a good example of how to think about these issues, right? And Jay mentioned the NGFS. The NGFS, in fact, is working on a handbook on blended finance that will be published for COP28 and address some of these issues, including whether there are practical and regulatory barriers that need to be considered by supervisors and regulators, whether those are in the banking sector, or that's to do with insurance, pension funds, investment funds, or other actors into the ecosystem. I think it's a good example because it's a very rich ecosystem. And so includes, from the public sector, includes anything from MDBs, from domestic financial institutions to development agencies. The private sector is a very wide range of actors, from philanthropists, donors, all the way to commercial banks like Jay, for example, but also investment funds, pension funds, and the broader global investors. So that ecosystem, that will allow you in some sense to study what the dynamics are, how this ecosystem is evolving. It's a relatively new approach, if you want, to emerging markets, but it's been around for advanced economies for a while. So how this ecosystem is evolving when applied to emerging markets, I think we can draw important lessons there. One of the issues, obviously, that some of these transactions, blended finance, are small. And so the issue of how to scale those, to get those numbers, sometimes we're talking about millions, and Charlotte and Torsten were talking about trillions. So how to go from millions to billions to trillions. At the same time, the smaller scale also allows you to think about some of this issue, right? How to pool, for example, some of this transaction, how to tranche risk so that we can attract different types of investor. So it provides a very interesting laboratory, if you want, on thinking about how to pool risk and how to scale. I think one of the issue here has to do with the, as I mentioned, if you want, the bankability of some of these projects. So how to bring more projects to market so they are more bankable. And there are examples that we looked at of facilities that have been put in place, so project preparation facility that combined with technical assistance, for example, can actually help bring more projects to market, right? From the design to the development to execution, and then to actually bringing this to market. There are issues also in blended finance. I think they're important because raise the issue, what is the optimal level of concessionality? How public money needs to come in, not only the level, but what is the efficient level? again, I think it's important to be mindful that not all transactions require public capital, and different transactions require different level of capital. And also how to bring, for example, pricing, right? We don't want to forget that market pricing has an important role to play. As an example, there's the State Department here in the US, they have a program in place where they're trying to call for offer, and it's a way, in some sense, to bring in the market side and the pricing, if you want, and to maintain essentially market discipline. There's also an issue how to think what is the best form of providing public capital, whether this is in the form of loans, for example, or whether it's in the form of equities, or whether it's in the form of guarantees, and what is the more efficient use of scarce, limited public capital that can be maximized to lever up private capital. And then, of course, there are issues that are related to the level of debt of domestic markets, right? So one way, for example, to address the issue of FX that has often been mentioned by the private sector is to have the participation of more domestic financial institutions. That lowers, if you want, the need for FX hedging. Now, obviously, large emerging markets have deeper, more liquid domestic market. When you go into like middle income or lower income countries, in some cases, the domestic debt to domestic market is missing there. So what is the right structural reforms that can be put in place to actually support and improve the macro environment, the financial backdrop, so you can pull actually also domestic resources. So I think it's a very important world to look at. Again, ecosystem, there's different players in place. The big question is how do you scale that, and also how do you standardize more? If you want to bring the global investor into this world, you need to scale, but you also need to standardize more. That's the only way to actually get to more liquidity. Then you get into this positive feedback loop where you can attract also the largest players in this space.
The holy grail of standardization. And you mentioned the important role of the MDBs and leveraging their resources. And Jay, I'm going to come back to you in a minute on the whole MDB reform question. But first, we have a couple from the audience that I'd like to address. And one for you, Fabio, one for you, Jay. Fabio, this question of corporate credit ratings, and has the fund been looking at those as well? Because a lot of private sector investment, of course, is going to go into the corporate sector. So any thoughts on that and the ESG implications of them?
So we have not done that yet, in the sense that we have done some work here. I think what Torsten and Charlotte were trying to show you, it was at the firm level, actually. So you look in the corporates. We're trying to get a sense of like how to measure impact, right? So whether the E as an approach was actually measuring climate impact. What they were trying to show you there was that if you think about how these E indices are environmental E, the ESG part is constructed, those are essentially picking a number of data. They are essentially ranking. So based on when you rank, for example, if you have like, I don't know, twice as much in terms of ranking, then doesn't mean that you are twice as much effective in terms of climate. And also they're very much sectoral. So what we're trying to do instead was to build new measure where you actually measure impact, and then you get a very different ranking of firms. That's what we have done in the chapter. I think there's more work that can be done. I want to stress the point that Jay was making though, right? So that there has to be a link between the work that is being done on the corporate side, if you want, and the work that has been done by financial institutions. In some sense, you think about a supply chain of data that start with the corporates, it goes to financial institutions, not just bank, but financial intermediaries, and all the way to investor. That supply chain has to be, in some sense, a continuum of data of high quality, comparable across jurisdiction, so that investor can do their work at price, risk, and opportunities in the climate space.
Yeah, and the measurement of impact have been tremendously difficult. But I would flag one other piece of the ecosystem here, that being the Glasgow Financial Alliance for Net Zero, who have a consultation out just now on exactly that, on sort of measuring the impact of all this climate finance. But Jay, the audience would like to come back to you on JETPs. You know, Torsten and Charlotte, I think, mentioned this early on, the Just Energy Transition Partnerships, and for your thoughts on the likely progress there.
Sure. Let me just, before I do that, say I want to applaud Fabio and his team and the IMF on what they're doing and this chapter, but just the the rigor and the value add of this analysis is fantastic, and we certainly agree on an awful lot of it. So let me put the context of JETPs for the audience that's listening, that I think is critical, because there's so much confusion, I think, in and around this term bankable projects. And what I believe is that when we talk about bankable projects, and most of you should know that JETP in the countries that are underway is late to produce bankable projects. And so we don't have enough scale and size of bankability. But what's so important is that before you get to bankability, you have a whole array of things that have to happen. And everyone keeps pointing to bankability, but let's start with the enabling environment. So one of the things JETP did is to ask the private sector members of GFANZ to write private sector recommendations of what an enabling environment looks like. Some of them are broad-based investment 101 of how do you get the environment there for any emerging markets economy, but specific to the countries involved. And then second is specific to energy transition. What is the enabling environment changes? So think rule of law in the macro level, and then energy transition PPAs. But specifics, if you don't have that enabled environment, we won't get there. Second, do you actually have a transition plan operationalized at the energy level upon which to fit in a series of projects? And we did with McKinsey for a country a plan where McKinsey laid out how one transitions, where the supply and demand transition from brown to green works without blowing the country up, and where it comes from, when it sequences in. And so you don't have repeat Ukraine type shocks where you have to double back. The green has to transition in, sequenced with the brown transitioning out. We need in the NDCs that level of rigor. And then you have an enabling environment, you have a operationalized pathway to transition of a country embedded in an NDC that's real. And one of the things that has to come out of the stock take is we have to have the next round of NDCs be massively improved. But then you get to what I call feasibility studies, projects that have feasibility studies completed. So what our project finance team started to say to me, Jay, is stop giving us concept papers and say, city then will produce for that government an analysis on bankability, because if you don't have a model of that project, if you don't have a feasibility study done, bankers can't add value to structure bankability. That bankability analysis comes once you have the core numbers of a viable project. And the world has such an extraordinary paucity of green scaled projects that would allow a bank like Citi to look at it and say, okay, here's how we could help. Now let's do MDB reform and blend in all of the risk mitigations. Let's look at bonds, loans, project structures, et cetera. But we need the system to scale the investment to create project feasibility study ready that are then able to be studied for bankability. So before we keep screaming about bankability, how about if we really get serious about all those other things?
Well, it's such a key point that you make about the enabling environment. And Fabio, let me come back to you here on what I've heard referenced as a bankability gap in some of these projects and so on. What do you think about the environment, and how can, for example, climate policies, as Torsten and Charlotte mentioned earlier, how can those help?
So first of all, I want to underscore how I completely agree with Jay that you need the prerequisite, right? So you need to have in place what is needed to make the conducive environment to able to attract private capital. From the macro backdrop, from the reform structure that needs to be in place, reducing uncertainty about the institutional and policy framework, to specific climate policies that need to be in place, right? We at the fund here, we've been insisting on carbon pricing for a while. Obviously, that is crucial. It's important. It's price signal to shift flows, but it's only one piece of the big set of policy that Charlotte and Torsten had highlighted. On the bankability gap, I think one issue that we want to emphasize here also, there's a difference between adaptation and mitigation. So if you look at emerging markets, about 2/3 of greenhouse gas emission comes from EMs at this point, but more than 50% comes from the larger EMs. So the transition part, the transition challenges, the transition financing need, a big chunk of that relates to large emerging markets that have deeper capital market, also domestically. When you look to the smaller emerging markets and developing economies, a very small share of transition comes from those countries. In some cases, for those countries, what really matters is adaptation finance, the need for adaptation finance. And that's where the lack of bankable project or lack of project to begin with, that's where even more visible. And that's where the link between those projects, even if they are executed, so design, execution of projects, the financing becomes even more challenging for those countries because often there is a lack of revenue streams that makes the project attractive for private sector. So I would first of all separate the adaptation challenges from the mitigation challenges in terms of both the structure of project and whether they can provide stream of revenues to the private sector, but also what kind of EMs you're facing when you separate adaptation versus mitigation. The second point, I think what it's needed here to help facilitate, again, all this stage, the development stage, if you want, from of this project, is to have in place technical assistance and capacity development. And that's where I think the MDBs, the development finance institution, those are well placed to do this because they know how to do it. They've been doing for a long time. They can actually make a difference on the ground along the life of this project. One last point I want to make, again, it's important also domestic capital markets, bringing in capital, pool of capital, they are already in those countries. Those countries knows more the reality on the ground. Not only they can bring domestic capital, but they can monitor this project. They are better linked to the realities on the ground. And so if we can increase the depth of these markets and bring more public, more domestic sorts of capital, I think that will help. And then maybe one final point on this. I think in the end, there's also an issue of like, not everything requires public money. There are some dedicated, specialized firms. They provide financing, private financing along the life cycle of this project. They operate in that part of the life cycle that is not the equivalent essential of private equity. It's a different kind of development finance for project. There are some of them. Obviously, they are not large, so how to scale that experience, that's the challenge. But there are some of them, they are able to provide capital, a specific part of the development cycle of this project, and then they essentially offload this project into the private sector. And that's one way to free up some of their balance sheet, but also bring in different capital, different range of private sector along the life of this project.
Well, I'll stay with you for just a minute, Fabio. But you had mentioned the kind of technical assistance and capacity building. It's an interesting idea in this space as more private funds come into an area that's historically been public financing, that you're also seeing more private sector efforts at direct technical assistance and capacity building as well, including in these just energy transition partnerships. And you've sort of partially addressed another question from the audience. But given what you said about the differences between adaptation and mitigation financing, do you think that climate adaptation finance is likely to remain more in the public domain, given how hard it is to quantify a return to private sector there?
I think there's two issues, right? So far, in terms of like the share of private capital that has gone between mitigation and adaptation, the vast majority has gone to mitigation. So there's most certainly a need to increase the share of private capital into the adaptation. What I was highlighting, though, are some of the challenges that are more unique to adaptation finance, which is not all these projects are designed or can be designed in a way that there is a certain revenue of stream that can be, if you want, securitized or can be used to attract private capital. If that is lacking, clearly there's a if you want to call it market failure or an externality, this needs to be that gap needs to be plugged by public money. But that's where the challenge is even more plenty, because sometimes we go in circle, right? Those countries where they have more adaptation need, where it's more difficult to bring private capital, often there are smaller countries, they're coming out of COVID with high level of debt, the fiscal outlook in some cases deteriorated, so they need public money, they don't have domestic public money, and that's where the international community, I think, can play an important role for those countries.
No, and indeed, if we get time, I'd like to come back to you on that sustainability questions. But Jay, so far in the way of us policy types, we've been talking mainly about problems. And one thing that you've done with your colleague, Stephanie von Friedenberg, is write a really interesting paper that has some of the answers specifically on MDB reform. And I wonder if you could share with us some of your takeaways from that paper.
Sure. I think the first thing I'd say is the paper is premised on Stephanie and I and the team, Joaquin Hugo included, that we looked at this and said, okay, we spent our entire careers doing this. If you were to get very granular about deals and specific structures that mitigate risk that would allow the MDBs to crowd in the private sector, what could you do practitioner level? And we actually surprised ourselves in terms of the plethora of opportunities to reform products and structures that could work. And so we came up with, in that paper, a list and a description, project by project, product by product, tool by tool, of how to perfect the mitigation. But it does start, importantly, with what's the mandate? Do we actually have, from on top, from the shareholders of the MDBs, a mandate to mobilize? And I don't think we do. I think, quite frankly, we have not the clarity that says we're going to measure mobilization. We're not going to measure net margin and lending. We're going to measure mobilization. Now, that's the starting layer, because if you were measuring with a maniacal urgency to say this has to happen, then actually all of the product innovations that we're talking about, people would be in the room with banks like Citi every day saying, let's get this right. Let's make sure we're crowding you in and that these structures actually work. Oh, you have a regulatory issue on this, let's fix it. We don't have that kind of intensity of dialogue. And that's what has to be shaken up, is there are so many financial institutions, pensions, insurance companies, banks that are prepared to mobilize, but need to be in the room to get these structures right. And it is a flaw to think at the 30,000-foot level that you can actually just put a mobilization ratio on everything, whether it's 4 or 5. We have to push the notch down one level. So I think we're going to have to split adaptation from mitigation in order to really think about this. I think mobilization of a V20 country versus a strong double B is very different. And I also think that, remember, part of what's happening this year is not just stock take, but we're looking at the path from Copenhagen to new collective quantified goal. And the new collective quantified goal is going to require us to have a quantum of how much money is committed by the developed world beyond the Copenhagen quantum. And we're going to have to decide how much is public sector and how much is private sector. And within it, we're going to have to be much more granular than we were with Copenhagen, which means that you're going to have to make not only assumptions around the overall mobilization rate, but you're going to have to bifurcate it. You're going to have to start to, maybe even more than that, you're going to have to start to trunch amounts of that and put mobilization ratios against them based on that purpose. And final thought, I completely agree with Fabio that not all adaptation is should be public sector. There are adaptation projects that, just like with social infrastructure, has cash flows that can be structured or securitized, and the private sector can be crowded in. But there's an awful lot that doesn't fit to that purpose. So let's not say blanketly the private sector is irrelevant to adaptation, but let's be very specific that it's a relatively small portion, and that the public sector use of its capital for pure grant-like, pure concessional, non-mobilizing money should go to that deepest of adaptation monies, and that the rest, we should be obsessed with the mobilization ratio and the products and tools that will mobilize to get to this 80 to 90% number that the IMF has pointed to of the need of the private sector.
And that specific topic, the mobilization of private finance for climate goals in emerging and especially in developing frontier economies, is going to be very high on the agenda in Marrakesh and at COP as well. And on that note, Fabio, can I come back to you on the debt question? You know, when you think about the implications of the energy transition, part of it is going to be in adding additional debt to emerging and developing economies that already have quite a lot of debt. So how big a source of concern is this for you?
I think that's an important point, right? So the starting point, again, I tried to make that point briefly before, but we're coming out of not only a pandemic, but a series of shocks in the last few years where the level of public debt has increased worldwide, where the fiscal outlook for a number of countries has deteriorated. And so we're talking about very large numbers here, again, from million to billion to trillion, and how to think about how to add those billion or $1 trillion to public debt. So we need to think, I think, creatively how to get there. That's why the use of instruments, and more first loss instruments like equity of guarantees, so that we don't rely entirely and uniquely on debt. I think that's one important point. Continuing to piling up debt on already very high level of debt, particularly for some of these countries. We have seen that with the global monetary policy tightening, the market access of some countries as the markets are closed. And so how to access public market, debt markets becomes very challenging for some of these countries. So I think we need to think creatively of other instruments that can be used here to mobilize private capital. So instruments, again, like equity guarantees. And that's one way to lever up private capital. The second point to make, I think, is, again, that at least from, if you remember the chart that Thorsten and Charlotte, they ended when they were talking about investment funds, it's for the largest country, there seems to be a positive relationship between the performance from E in the ESG and the ratings. But if you look at the middle to lower income countries, that correlation is actually negative. So doing a good job on the E front doesn't mean that you get, in some sense, rewarding on the rating side. I think so there is some need, I think, the work that need to be done there in terms of how to think to bring environmental and climate into consideration when we think about ratings, right? So issues like mineral wealth or forestry, or some of these issues that have an impact, may have an impact in terms of the long-term sustainability of some of these countries. At this point, they are not necessarily part of how we think about ratings for some of these countries. So rethink some of that framework, so that some of these issues that will have for some of these countries an important impact in terms of the debt sustainability over the medium to long term, and how to make them relevant when you think about ratings, so that they actually get not penalized, but actually get rewarded if they do their homework in terms of climate.
May I add something?
You may.
So I just want to say that I think that as you look at the barbell of MB right now, of the high end and the high grade, and then the real low grade, we have exactly what Fabio talked about there in terms of this kind of correlation differentiation on climate. We also have some other interesting things happen. We have the weight of this of the weakest credit economies in the world, inability to fund, sucking down the whole. It's like a weight on not just rating, but a lifting of the risk premium in terms of the yields on everything, because we have a debt crisis that's unresolved, and the market doesn't see a pathway to common framework resolution, or those that might go into it, how they would get out. And so the whole system is weighted down by 40-some countries that can't fund themselves, many of whom are stuck in a common framework nightmare. And unless we actually realize that when we have to transition and we have to fund climate and development, that we're going to have to wrestle with this, and the strategic global politics of this have to be resolved because it's weighing everything down. And then secondly is, I think that the IMF and the FSB should be really looking at some of the transition systemic risks that are out there. And in part, not because of the banks, but because if we were to take the, let's say the Yellen principles and apply them to the asset side, the net zero asset owners and asset managers, and you look at how they are going to operationalize transition. I spent time this weekend with one of them. The path to operationalization means that you're going to go from European equity to global equity, but you're going to go to fixed income. And when you go to fixed income, guess what? Half of the fixed income portfolio is in the sovereign space. So if you assume that at some point the asset managers are going to have to negative screen and or tilt away from the darkest of brown as they commit, because they're either going to uncommit or they're going to operationalize. If they operationalize, fixed income and sovereign paper is going to be part of it. And at some point, we will strand the weakest credit that is also the darkest brown. They just simply won't fund, or they will start to fund 200, 300 basis points wide of where they're funding at the time, because the asset owners are actually going to move along this curve of operationalizing. I can't call the timing of how fast that actually starts to kick in, but if we don't actually start to look at the systemic risk of when and how that happens, and particularly how that affects the double B downs, we can have unintended consequences of this that are problematic. We still have time to look at that now, and it is of concern.
It's a fundamental and very uncomfortable truth. So I have to thank you, Jay. Not only have you answered that question, but you've also set out a topic for another entire webinar. But I wish we had more time. This has been a terrific discussion. So thanks to you all, Torsten, Charlotte, Jay, Fabio. Really great discussion. Thank you so much.
Thank you to the IIF and the IMF for this. It was fantastic. Thank you.
Well, thank you for organizing, and thank you, Jay.